I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. Go to wealthtrack.com for more information. This week on Wealth Track, a rare interview with great investor Jean-Marie Eveillard, First Eagle's legendary value investor on the turbulent and shifting economic currents flowing around the world, from the U.S. to Europe to the Middle East to Asia, and his personal strategies to navigate them. Next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Research affiliates, an efficient index for an inefficient market. Wintergreen, your home for global value. And Rosalind P. Walter.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack at the Museum of American Finance in the heart of the financial district on Wall Street. In case you didn't know it already, it's hard to miss. The market is still in a danger zone. That is the sobering reminder recently brought to my attention by Wall Street's longtime #1 independent research firm, ISI Group. According to ISI, almost all of the great financial crises in history have occurred between late August and mid-October. As their list illustrates, the 5 most recent market tsunamis past, Black Monday in October of '87, the 1998 Russian long-term capital management meltdown, the bursting of the NASDAQ bubble in 2000, the subprime implosion in August of 2007, and the September 2008 collapse of Lehman Brothers occurred in the transition period from late summer to fall. And as we all know now, some leading European bankers and officials have been predicting the Eurozone sovereign debt crisis has the makings of another financial crisis of similar magnitude. Well, how do you navigate these kinds of landmines as investors? This week, we decided to consult a legendary investor who has one of the best long-term track records in the business. He is Jean-Marie Eveillard, now Senior Investment Advisor for the First Eagle Funds, but until 2009, portfolio manager for several of its funds, including nearly 30 years running the flagship 5-star First Eagle Global Fund, one of the pioneers in international investing. Eveillard's exceptional track record and risk-averse approach earned him 2 Morningstar Fund Manager of the Year awards and its Lifetime Achievement Award as well. Jean-Marie is a deep value investor with a history of investing against the herd. But unlike some of his peers, he is loath to place big bets that could result in large losses, even over the short term. Until the financial meltdown in 2008, when the Global Fund experienced a 21% loss, still far better than competitors in the markets, the Global Fund had suffered only 2 years of small losses. A student of financial markets and a well-known worrywart, Eveillard's latest concern is the fragile state of recovery in the developed world. He believes we are seeing a fundamental shift in the economic landscape. I asked him what's changed.
Many academics, economists with Wall Street firms didn't see it coming because they looked at the 90s, beginning of the 21st century, and for 15 years, we had overall prosperity. The 2001 recession was very modest. For 15 years, we had low inflation, at least as measured by the Consumer Price Index. So the authorities felt self-satisfied, very happy with themselves. What they didn't notice was that the overall prosperity was built upon tremendous increases in debt. And what they didn't pay attention to is that if you let the credit boom go on too long and be too strong, then at some point it will turn into a credit burst, just like night follows day. And when the credit boom turned into a credit bust, it's not just that the authorities didn't see it coming. When they realized what was happening, they took steps, admittedly, to stabilize matters. The Federal Reserve took unprecedented steps that had never been taken by the Federal Reserve since its creation in 1913. They ballooned the balance sheet of the Fed. They took short-term interest rates down to zero. Short-term interest rates have been at practically zip for almost 3 years now. And on the fiscal side, the government and Congress decided to increase government spending so that the budget deficit ballooned as well. And government debt, of course, as a result, went up tremendously, to the point where, recently Standard & Poor's decided to downgrade Treasury notes and bonds.
So where has that left us? All of this intervention and this credit bust and...
As I said before, it has stabilized matters. For a while, beginning in 2009, the economy started recovering. It continued in 2010. But this year, the economy seems to be stalling a bit.
Now, was that a surprise to you?
Not much. It didn't surprise us much, and it should not have surprised too many people too much, because after all, in 2009, that's when Reinhardt and Rogoff published their book. This time is different, where they said one major characteristic of substantial financial crisis is that in the aftermath of the crisis, the economy is sort of weakish for a number of years.
Do you think that we in the United States and possibly the developed world, the rest of the developed world, I mean, we know what Japan continues to be in its same kind of funk,
right,
but the last 2 decades now, but do you think that is our fate in the US and possibly in much of Europe?
It's possible, but I think what is more likely, because neither in the US nor in Europe investors and people in general are particularly patient, the pressure will be steady on politicians to don't just stand there, do something. And so far what they have done doesn't seem to bear much fruit, but they'll try again.
But what difference is that going to make in the outcome, the actual outcome of what happens, the kind of results we get in the economy? Well, it hasn't made much difference so far, right? So is it going to make any difference in the future? Or?
One possibility is Japanese experience. All right. The other possibility is that another major crisis may erupt, because at some point, if the monetary stimulus becomes too much, then long-term interest rates would go up.
So you're no longer running the First Eagle Fund anymore. You're a consultant or advisor to them, but you are, running your own money. So what, how are you positioning your portfolio for which scenario?
Well,
right now.
I also have a large stake, personally, as a percentage of my financial assets, I have a large stake in the funds I used to run.
Yes.
But I have some money which I run, I have a personal account, but I think it looks a little bit like the First Eagle Fund's portfolios, in other words, a portfolio of equities, because I think there are some equities, even though I may have sounded somewhat pessimistic from the top down in terms of the big picture, nevertheless, I believe that there are some equities that are attractive, both in the US and outside the US, particularly in the US, in Europe and in Japan, large cap, multinational stocks. In Asia, stocks of companies that are particularly active in the domestic consumer market, because in Asia, I think governments understand that the export model, which has helped them so much over the past 10 or 20 years, now does not apply anymore, and that they have to move towards an economy that's based more on domestic consumption as opposed to exports. So there are equities which I believe are attractive. Would it be only because there will be repeated attempts to stimulate, including from monetary stimulus, and equities? Yes, they are financial assets, but to some extent they are real assets. And to me, equities look, or at least some equities, look a lot better, not necessarily over the next 6 to 12 months, but look a lot better than bonds, not just bonds in the US, but bonds almost anywhere. And with a position in gold as protection against, as Peter Bernstein used to say, protection against extreme outcomes, as some kind of an accompaniment to the equity portfolio, just in case the international monetary system, or what passes for a system today, goes haywire.
So explain, why gold, even at these levels, I mean, why you wouldn't, or are you trimming positions, or since it's appreciated so much over the last couple of years, or?
Matt McLennan has trimmed positions, and I was in complete agreement with him, because as the price of gold was going up, then the gold as a percentage of assets was going up as well.
Right.
And I think he likes the idea of keeping it, at around 10 or 11% of the assets of the global fund and the overseas fund.
So is that something that you established basically as kind of a benchmark holding as well, around 10% of the portfolio gold, or did you have one?
It can be more, it can be less, but I think his 10 to 11% is perfectly reasonable. And now it's a fair question to ask, 10 years ago gold was at $250, $300 an ounce. Today it's $1,850. Is gold too high? Gold has no intrinsic value, and that's why many investors decline to even consider it. Although one could say at the same time that a dollar bill in a wallet has no intrinsic value either. It's worth what the government tells you it's worth. Currently, above ground gold, globally, that's about $10 trillion. About $5 trillion is jewelry, about $1 trillion is central banks, a little more than $1 trillion that own gold in their vaults. A little more than $1 trillion is in the hands of private investors, and there is fabrication and other things.
So about $10 trillion is what's out of the ground in gold, right, globally.
That has been taken over the centuries out of the ground, and since gold is practically indestructible, it's still there.
Right.
The 10 trillion, unfortunately, I forgot, I'm getting old. I forgot because I knew the number associated with financial assets throughout the world, bonds and stocks. It's many times the 10 trillion.
Oh, many.
Right. So, from that standpoint, I don't believe that the price is too high. In fact, one argument was in one line was too much paper, too little stuff. Paper being debt and all levels, and stuff being gold. And I think we're still in a world where there is too much paper and additional paper being created every day, more money being printed, too much paper, too little stuff.
So your personal view of gold, aside from First Eagle, what would be an excessive amount of gold to own as far as a percentage of your investable assets? Is there?
I think once you get to 20 or 30%, it's quite a lot. Although admittedly, if there is a major trouble
crisis,
in the international monetary system, if you have a portfolio of equities, which is because I think what's appropriate is to have about 70-75% in equities, maybe 10 to 12% in gold, and the rest in cash, just to take advantage of opportunities. Right. I mean, cash by itself, either in dollars or in euros or in yen, is a terrible asset because it yields nothing. And in Europe, in Japan, and in the US, they keep printing money. So if it yields nothing and they keep printing money.
This is a change. There are sea changes going on in this country and globally. So where are you seeing opportunities, whether we like the changes or not, they're reality. So where are you seeing opportunities, or are there being opportunities created for a value investor globally by these changes?
Yeah, I think the key question is whether we are still in the post-World War II economic and financial landscape, or whether we are in a new, undefined, possibly threatening landscape.
And your answer to that is?
My answer to that is I don't know, but because, as Ben Graham used to say, the future is uncertain. Only God knows, and he ain't telling. So I see that there is a possibility that we are in a new, undefined landscape, and that's where gold comes in and provides possible protection just in case something bad happens.
So let's talk about the multinationals. So you
Right.
still think, as a value investor, that there are some values to be had in the large cap multinational space.
Some.
So some. I mean, not a lot. You're not seeing tremendous value when you look around the world globally. Is it?
No, and if you take the U.S., I think Robert Schiller is right. He does what Ben Graham used to do, which is he takes the price-earnings ratio, but the earnings are the cyclically
right. The last 10 years, I think he averages them right. His CAPE ratio.
And in that respect, the overall stock market does not look particularly cheap.
No, I think he says it's like moderately expensive.
That's right. The only major stock market that's truly cheap continues to be Japan, of course. But
so individual securities, which
right.
And when we're talking about what you're investing in personally, what are some? Give us some names of companies that.
I hesitate a bit to mention names because somebody once told me, how come you don't run a more concentrated portfolio? Because our portfolio is fairly diversified. It's not diversified in the sense that some portfolios are diversified where they are sort of quasi-indexed. They are very close to the benchmark. That has never been our case. How come we don't have a more concentrated portfolio? Number one, because I'm not as smart as Warren Buffett. And number two, because truly people say, well, why don't you just invest in your best ideas? But I don't know in advance what will turn out to be my best ideas. So that's why we're diversified. So I hesitate a little bit to mention names because I would have to choose among.
Right. So are there companies that exemplify the kinds of are there names of companies
yes,
that kind of exemplify the kinds of
sort of
investments that you're making?
Illustrate.
Yes. Right.
I think the stock may be somewhat too expensive. Colgate-Palmolive, for instance. The business has been extremely stable. It's highly profitable to some extent because when they buy toothpaste, Colgate is involved in much more than toothpaste, but when individuals buy toothpaste, if they initially decided that they would buy Colgate, they continue to use Colgate for the rest of their lives. Maybe because it has to do with the fact that it goes into their mouth and they're not particularly interested in having a private label.
Mm-hmm. But they're brand loyal.
Yes, there's a great brand loyalty. But as I said, it's to illustrate it, and they're all over the world, including in South America, in Asia, because I think we have to keep in mind that from a long-term standpoint, and China, India, Brazil, they will have bumps along the road, of course, but from a long-term standpoint, there is very little doubt that the East is rising and the West is declining. So one way or the other, either directly by buying stocks in those countries, so-called emerging countries, or by buying stocks of American, Japanese, or European companies that have major exposure to Asia and South America. Those are stable businesses, highly profitable, exposure to emerging countries, and they are not, Colgate is certainly not a great bargain, at $90 or so a share. So I mentioned the name just to illustrate, but that's the kind of securities I'm talking about. Now, it's not necessarily consumer-related stocks. In Germany and in Japan, for instance, where in terms of what they call industrial technology, they have extremely dominant companies, then it can be industrial technology where you have companies that have a genuine franchise and what Buffett calls a moat, a competitive advantage.
Again, such as what?
Well, for instance, Fanuc in Japan, which makes robots, known for robots, but also actually makes most of its money with software for machine tools, and truly dominates worldwide the field. So those, and there are quite a few, and Japan, we've done and we continue to do a lot of work in Japan because, as I said before, it's truly a cheap market.
Right, it's being shunned by most other investors.
Because it's been so disappointing for so long.
So we always ask our guests for the one investment for a long-term diversified portfolio, and you're not allowed to recommend your own funds that you're invested in from First Eagle, but you are here because of your track record there, so they speak for themselves. So what would it be?
I think I would still say gold. Again,
the bullion, the metal.
Yes, although certainly not junior mining stocks.
So you want a producing gold mining
yes,
stock?
Yes, that's right. Major gold mining stock, a combination of bullion and or the ETF and gold mining stocks.
So Jean-Marie, one last question. Given the state of the world today and this global slowdown that we're seeing, and as you said, the rise of the East and the decline of the West, and are you, as far as your investment stance, are you more defensive? Would you be more defensive now than you've been in the past?
Yes, and it shows in two respects. One, the gold position,
right,
and two, some cash because maybe there'll be opportunities to buy equities at lower prices. I don't know, but some cash to seize opportunities if they show up.
So more to seize opportunities than as a defensive position?
Well, it's also a defensive position. In fact, I would argue that cash is the combination of gold. If one looks at gold as a substitute currency, then one should look at it as cash, except that cash in a currency that cannot be printed. So a combination of gold and some cash. Yeah.
Jean-Marie Eveillard, it is such a pleasure to have you again on Wealth Track.
Consuelo, it's always a pleasure to be here.
So thank you very much.
You're welcome.
At the conclusion of every Wealth Track, we give you one suggestion to help you build and protect your wealth over the long term. This week's action point agrees with Jean-Marie's one investment recommendation. It is to invest a portion of your portfolio in gold and gold-related investments. Up to 10 to 12% is his recommendation. Over the years on Wealth Track, guests have called gold an insurance policy against extreme outcomes. It certainly has worked out that way. Bullion is up 7-fold from its 20-year 1999 bear market low, delivering compound annualized returns of 18% versus the S&P 500's paltry 0.7% average through recessions, the bursting of the tech, credit, and housing bubbles, and offering a safe haven through the recent sovereign debt crisis. High-performing mutual fund manager John Hathaway of the Tocqueville Gold Fund calls gold and gold mining stocks a golden mulligan. For non-golfers, that means if you don't own it yet, you have another chance. Hathaway points out that gold bullion is currently underowned globally at only 1% of the world's financial assets, as are gold mining stocks. However, since 1999, gold mining shares have underperformed the metal by a huge margin. Tocqueville's Hathaway says that divergence has created an extraordinary opportunity and that gold mining stocks offer inherent advantages over the metal itself: dividend income, growth, and takeover potential. Both the Tocqueville Gold Fund and the First Eagle Gold Fund, which Jean-Marie used to run, have excellent long-term track records and own both bullion and gold mining stocks. Next week on Wealth Track, we will have a Wealth Track exclusive with another great investor, Legg Mason Clearbridge Advisors Chief Investment Officer Hirsch Cohen, who managed their acclaimed appreciation fund for 31 years. For those of you who want to see our Wealth Track interviews ahead of the pack, we have a new opportunity for you. Subscribers can now see our program as early as Thursday morning on our website, along with timely interviews exclusive to Wealth Track web subscribers. To sign up, go to our website, wealthtrack.com. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales. Investors seeking exceptional opportunities globally. Research affiliates. An efficient index for an inefficient market. Wintergreen, your home for global value. And Rosalind P. Walter.